Welcome to the Franks Report. I'm Philip.
And I'm Jessica.
So imagine a massive national jobs report drops. The numbers hit the wire, and the economy just added a record number of jobs.
Right. Unemployment is sitting at an all-time low. It is, by all accounts, objectively fantastic news.
Exactly. So you buy in, right? You're expecting the price to skyrocket.
Right.
But then, 3 seconds later, the stock market absolutely crashes, and it takes your entire position with it.
Which is just the worst feeling.
It really is. And the answer to why that happens isn't that the market is broken or rigged against you. It's that you are fundamentally misreading the schedule of the chaos.
Yeah, that's what we're getting into today. But real quick, we want to remind you to pick up a copy of our book, The Funded Micro, Modern Future Strategies for the Prop Firm Era.
Yeah, it basically covers all the foundational strategies that we are unpacking in the show today, just updated for the modern trading environment.
And we also want to give a massive thank you to our sponsor, TradingView.
Oh, absolutely. They are the absolute fastest way to follow global markets.
They really are. Their platform features this incredibly sleek launch chart interface that just, it strips away all the friction and puts the data right in front of you.
So if you want the business standard for charting your trades, check the description of this deep dive. You can actually save $15 by using our referral code.
Right. So let's get right into the mission for today's deep dive. We're looking at a stack of sources that break down market mechanics, specifically tailored for a complete beginner.
And the core focus here is the economic calendar. We're going to unpack exactly how you can use this tool as essentially a master schedule for the global financial markets.
Which is such a vital starting point, because when you look at a trading screen for the first time, it's just sensory overload.
Oh, yeah.
You've got numbers flashing red and green, charts are spiking aggressively all over the place, and it all feels completely random.
But the source material makes this really critical point. Those major aggressive movements are almost never random.
Right.
There's a deeply structured schedule to them.
Which completely shatters the biggest misconception beginners have. Most new traders look at an economic calendar, which is basically just a public list of planned data releases, government reports, central bank stuff, and they treat it like a crystal ball.
Yeah, they operate under this illusion that if they can just, guess what the inflation number is going to be tomorrow morning, they can predict price direction and get rich overnight.
And operating like that is genuinely the fastest way to blow up a trading account.
It's guaranteed. So the fundamental shift that you have to make right now is viewing the economic calendar purely as a risk management map.
Exactly. Its primary function isn't to tell you which direction to trade. Its function is to highlight upcoming periods of extreme, uncontrollable volatility.
So you can adjust your exposure.
Right. Think of it like checking a marine weather radar before you take a sailboat out onto the ocean.
I love that analogy.
Right, because when you look at that radar and see a massive dark red storm cell scheduled to hit at, say, 2 o'clock in the afternoon, you don't know exactly how the wind is going to blow. You can't predict the trajectory of every single raindrop.
No, of course not.
But you know with absolute certainty that you need to avoid sailing your boat directly into the center of it.
And that visual really makes the structural layout of these calendars make so much more sense.
It does.
Because when you pull up a professional economic calendar, it is built for rapid defensive data consumption. You're going to see a very standardized set of columns.
You've got the date, the time of the release, the country or currency, the data effects, an importance level, and then the numerical data itself.
And that importance level, that is where your eyes need to go first.
Yeah, platforms almost universally color code these events so you can gauge the expected magnitude of the volatility.
So you'll see dozens of events marked in yellow or gray. Those are your low-impact events.
Basically background noise.
Exactly. They rarely cause any significant disruption, and you can generally just leave your positions running right through them without a second thought.
But then, moving up the scale, you have the orange-coded events. These are your medium impact ones.
Right. They might cause a minor ripple at price.
Or maybe provide a little burst of momentum to help an existing trend continue on its path. But they generally aren't going to flip the entire market upside down.
But then Then you hit the red-coded events.
High-impact reports.
Yeah, this is your severe weather warning. We are talking about major fundamental drivers. Things like non-farm payrolls, the monthly U.S. employment report known as NFP, or the Federal Reserve's interest rate decisions.
And when a red folder event hits the tape, the price can move so violently and with such unpredictable force that it literally jumps right over your stop-loss level.
Your safety net just tears completely open.
It does. But I have to admit, something about this always baffled me when I first started looking at these specific data columns.
What do you mean?
Well, let's revisit that scenario from the opening of the show. We understand that a red folder event is dangerous. But let's look at the actual numbers on the page.
Okay.
You have three main columns: previous, forecast, and actual. If the actual data drops, and it is just a phenomenal jobs report, more people are working, the economy is thriving, why on earth does the market instantly panic and sell off?
It's a great question.
Like, what mechanism am I missing there?
It feels completely counterintuitive until you understand how institutional money operates. The market is not a real-time reflection of today. It is a forward-looking pricing mechanism.
Meaning it lives entirely in the future.
Exactly. The forecast column on your calendar, that represents the consensus of thousands of economists and analysts. Over the weeks and days leading up to that red folder event, the market has already factored that expected number into the current price.
So the market has basically already bought the rumor.
Precisely. If the consensus forecast expects a spectacularly strong jobs report, institutional buyers have already pushed the price up for 5 straight days in anticipation.
So the good news is already priced in.
Yes. So when the exact time arrives and the actual number comes out, let's say it's strong but only moderately strong, it is perceived by the algorithms as a massive disappointment relative to those sky-high expectations.
Wow. So the true volatility isn't driven by the raw data itself.
Not at all. The volatility is driven by the gap between the actual data and the forecast. The wider the gap, the bigger the shock.
Right. If everyone expects a 10 out of 10 and you deliver an 8, that's a failure in the eyes of a forward-looking market.
And the price violently corrects downward to reflect that disappointment.
And I think that leads directly into a very specific trap outlined in the sources. It's this nuance that algorithms catch in milliseconds, but retail traders miss constantly.
Oh, the asterisk trap.
Yes.
Yeah.
You have to keep a relentless eye on the previous column, not just the actual column.
Because of the revisions.
Exactly. Government agencies are notorious for this. Let's invent a concrete scenario to see how this plays out. Imagine it's Friday morning and the current month's headline jobs number flashes across your screen in bright green.
It beat the forecast.
Right. The economy looks bulletproof, you click buy, but suddenly the market tanks. Why? Because quietly, right next to that shiny new number, the agency placed a tiny asterisk next to the previous month's data, secretly revising last month's numbers downward by a massive amount.
So the headline looks structurally sound, but the foundation it was built upon was just quietly gutted.
Yes, and the algorithms are programmed to scrape that entire data set, including the revisions, in a fraction of a second.
They instantly calculate that the net economic growth is actually negative, and they just dump their positions while human traders are still reading the headline.
It's wild. You cannot just read the single data point. You have to understand the context of the entire row.
But, you know, even if you master reading the actual versus forecast columns, and you somehow successfully dodge the revision traps, the source text highlights a completely unforced administrative error that wipes out beginners before the data even drops.
Oh, I know what you're going to say.
And there is honestly no worse feeling in trading than this. I am talking about time zone synchronization.
It is such an agonizing tax to pay for a clerical error.
It really is. You wake up early, you grab your coffee, you sit down at your terminal feeling fully prepared for a 9:30 a.m. data release.
Right, you're ready to go.
But you open your platform and you see a giant red candle already wiped out your account an hour ago.
Because your economic calendar's default server clock was set to UTC or London time instead of your local time zone.
Yeah, or like perhaps daylight savings time just shifted in the United States, but Europe hasn't shifted yet.
Oh, that happens all the time. And suddenly all the European central bank announcements are hitting an hour earlier than your math predicted.
The sources make it very clear. Most professional platforms allow you to anchor the calendar to your specific local city with one click. Do it once. Double check it.
And then build a daily routine where you scan that sync calendar at least 30 minutes before you place a single trade.
Now, assuming you actually have the right time on your screen, how do you filter what to look at? Because the standard calendar drops dozens of data points every single day.
Right, if you try to track all of them, you will suffer from severe analysis paralysis.
You have to filter for strict relevance.
Yeah, if you are trading U.S. equities or, say, Treasury futures, you only need to see high-impact red folder events related to the U.S. dollar.
You simply uncheck the boxes for, like, medium-impact manufacturing reports out of New Zealand.
Yeah.
Just visual clutter.
Conversely, if you are trading a currency pair like the euro against the US dollar, you have to monitor both sides of that equation. You need high-impact alerts for the Eurozone and the United States.
If it doesn't directly move the needle for your specific instrument, just remove it from your screen.
So let's transition into the actual mechanics of the storm.
Okay.
We know what the numbers mean, and we've filtered the calendar. What is physically happening in the market in the minutes before and after a red folder hits the tape?
Right.
The text describes this phenomenon called the pre-release freeze, and I'd love to unpack the mechanics behind that.
Yeah, so in the 5 to 10 minutes leading up to a major report, you will notice the volume on your chart drops off a cliff.
The price action becomes completely stagnant. Maybe it's just ticking up and down by fractions of a penny.
The market is essentially holding its breath.
It's a deeply uncomfortable quiet. But what is actually happening under the hood? Like, why does it freeze?
Well, it comes down to market makers. Market makers are the massive institutional entities that provide liquidity. They're basically always willing to buy from you or sell to you.
Right.
But during a high-impact news release, the risk of toxic one-sided order flow is just too high. So the algorithms that run these market makers instantly yank their resting orders off the limit book.
They simply step away.
Exactly. And when those big orders disappear, there is a massive vacuum of buyers and sellers. This creates what the sources call thin liquidity.
Which means the gap between the bid price, what buyers are willing to pay, and the ask price, what sellers are demanding, widens dramatically.
Right. Under normal conditions, that gap is, a penny. But during a news release, that gap might widen to 50 cents.
And that is exactly how slippage happens.
Yes. If you try to execute a trade in that vacuum, or if your stop loss gets triggered, there is no market maker standing there to take the other side of your trade at a fair price.
So your order gets dragged violently down the ladder to whatever the next available price is.
Which could be miles away from where you intended to exit.
Going back to our ocean metaphor, this pre-release freeze is exactly like the ocean tide pulling back eerily from the shoreline right before a tsunami hits.
Oh man, yeah. The water just disappears, the beach gets quiet, and, a massive wall of energy is coming.
Entering a new trade during this freeze is not trading. It is gambling on unreleased data while standing on an exposed beach.
The professional approach is to completely clear the beach. You either close your short-term positions entirely, or you move your stop losses to a break-even point well before that data drops.
And when that wave finally hits, we enter the post-release stabilization phase.
Yeah, the moment the data publishes, the algorithms react to the surprise gap, and the price whipsaws.
It violently spikes up, instantly crashes down, then spikes up again as different institutional models argue over how to price in the new reality.
The overarching guidance from the sources here is aggressive patience.
You have to let the dust settle.
The text suggests waiting anywhere from 5 to 15 minutes before even looking for new trade setups.
Because watching how the market actually closes a 5-minute or a 15-minute candle after a news release gives you infinitely more actionable information than trying to chase that initial erratic spike.
Let the algorithms finish fighting. Let the market show its true directional hand first.
So how do you turn all this defensive theory into a practical, actionable habit? The sources lay out a very clear framework for a weekly routine.
And it actually starts before the market's even open.
The Sunday evening briefing.
Right. Before the chaos of Monday begins, you sit down with a blank calendar and review the entire week ahead. You are hunting for the big 3 volatility drivers.
So you want to isolate any central bank interest rate decisions, any major inflation data like the consumer price index and the major employment reports.
You log into your platform, you filter out the low impact noise, and you explicitly mark these red folder dates on your charts.
The goal of this Sunday prep is to ensure that a massive Federal Reserve announcement never blindsides you in the middle of a random Wednesday afternoon.
But more importantly, charting these out helps you identify dead zones.
Dead zones are fascinating from a psychological perspective.
They really are. Let's say your Sunday prep reveals that a massive interest rate announcement is scheduled for Wednesday at 2 o'clock. You can logically deduce exactly how the market is going to behave on Monday and Tuesday.
Because institutional money is not going to take massive, multi-billion-dollar directional bets 48 hours before the central bank changes the cost of borrowing money.
No, they are going to sit on their hands and wait.
Which means Monday and Tuesday will likely lack any real trend.
The price will just chop around sideways. It generates lots of messy wicks on the chart, trapping amateur traders who are trying to force momentum that simply doesn't exist yet.
By identifying that dead zone on Sunday, you save your mental capital. You understand the macroeconomic context of why your technical breakouts keep failing.
And that perfectly highlights how fundamental tools like the economic calendar and technical analysis tools like price charts must work in tandem.
They are not opposing philosophies.
Not at all. When you see a high-impact event approaching on the calendar, your very next step should be looking at your price chart to identify major technical levels nearby.
Like a heavy resistance zone the price has been trapped under for 3 weeks.
It's exactly. Major macroeconomic news releases are very often the exact catalyst required to push stagnant prices through those stubborn technical levels.
You aren't using the calendar to predict the direction of the breakout. You are using it to anticipate the precise timing of the momentum injection.
Now, how you physically handle your open trades during that momentum injection heavily depends on your specific strategy.
Yeah, the sources draw a very clear line in the sand between intraday traders and swing traders.
Going back to our tsunami metaphor, if you are an intraday trader, meaning someone looking to capture small price movements within a single day, you are essentially building sandcastles on the shoreline.
So when the tsunami warning sounds, your only professional option is to be flat.
Yes. Being flat means you close all open positions. You take your capital completely out of harm's way.
But if you are a swing trader, your time horizon is much longer. You might be holding a position for weeks.
Right. So in our metaphor, you aren't on the beach. You are in a massive, heavy galleon anchored miles offshore.
The macroeconomic wave is going to rock your boat, absolutely.
But because your trade is based on a longer time frame, your stop loss is placed wide enough to absorb that temporary violent whipsaw without getting clipped.
You can ride out the storm because your structural foundation is built for it.
It really reframes how you look at your screen every morning.
It absolutely does. And that is the overarching takeaway for you today.
The primary purpose of an economic calendar is not to hand you a reason to enter the market. It is a highly tuned defensive radar designed to tell you exactly when to stay out.
It keeps your capital safe from unpredictable liquidity vacuums.
Which leaves us with a truly fascinating concept to mull over based on the mechanics we've unpacked today.
Yeah, we established that the market spends days or even weeks quietly pricing in the consensus forecasts of economists.
Right. And we know that the violent chart-breaking volatility we see at the moment of release is entirely driven by the surprise gap between expectations and reality.
So the next time you watch a red folder event hit the tape and the market goes absolutely crazy, ask yourself, are traders really trading the underlying fundamental health of the global economy?
Or is the market just a real-time ledger of mass human psychology, rapidly recalculating the collective shock of the experts being entirely wrong?
It is a completely different lens through which to view your charts.
That is going to wrap up our deep dive for today. We highly encourage you to visit www.franksreport.com for more resources.
And absolutely make sure you check out the book, The Funded Micro, Modern Future Strategies for the Prop Firm Era, to further build on the defensive foundations we covered today.
Finally, be sure to follow the show wherever you catch your deep dives. We will see you next time.